Any company whose revenues and earnings are expected to grow at a faster rate than the average company in its industry is considered a growth stock. Capital appreciation is the primary goal of growth investors, so they tend to put their money into growth stocks, or shares of relatively new or small companies whose profits are expected to increase at a faster rate than those of their industry or the economy as a whole. Despite their often inflated price tags, growth stocks can yield significant gains if the market's expectations are met. As a result of their superior growth rates, the stocks in question make for great long-term investments. Similarly, the risks of investing in growth stocks are substantial. In addition, some companies put an unhealthy emphasis on revenue growth at the expense of other considerations, which can lead to disastrous consequences if market growth expectations are not met. In today's stock market, in particular, investors have been moving away from growth equities and toward value firms, which are less sensitive to monetary tightening and inflation. Because of this, the bearish momentum in these investments has increased, allowing investors to buy growth stocks at more affordable prices. To amass substantial wealth through the stock market, a person must know when and which growth stocks to purchase. Because of this, I have compiled a list of stocks that I believe have the best chance of experiencing significant growth between now and 2023. Keep in mind, however, that stock prices are notoriously volatile and can suddenly drop at any time. Marvell Technology, Inc. suggests extreme caution. Company name: Li Auto Inc. Zscaler, Inc. Bill.com Holdings, Inc. Coinbase Global, Inc., a subsidiary of Cloudflare, Inc. Now, I'll explain why these stocks are marvels in my opinion. The stock price of Marvell Technology, which specializes in the design and marketing of integrated communications and storage circuits for high-speed network equipment, hard disk drives, and consumer electronics, has fallen by 33.72% this year, to $59.20. Investors have been unloading their growth stocks, leading to this situation. Nonetheless, Marvell has recently reported that, in the case of their cloud data center Ethernet switch, port shipments have more than doubled year-over-year, achieving a record high market share of 31% in Q4 2021. In spite of its poor showing, Marvell is expected to experience explosive growth over the course of the next 2 years. The company has been successful because of the consistent interest in its cloud services. The forecast for 2022 calls for a net sales increase of 50.3% to $4.46 billion, followed by an increase of 46.7% to $6.1 billion. Meanwhile, Marvell's bottom line is forecast to get worse in 2023. From a net loss of $421 million in 2022 to a loss of $291 million in 2023. It is anticipated that the stock price of Marvell will increase as a result of this enhancement, with net margins increasing to 4.76% annually. In addition, the IT company is in good financial standing in 2021, with net debt of only $444 million. In addition to a leverage ratio of 20,210.48x. As well as that, researchers, with a forward earnings per share estimate of $91.20, we are extremely bullish on the company's future growth prospects. Reduce the EBITDA by 20.4, as well as a P/B ratio of 3.2. The valuation metrics used to assess the firm are unrealistic. The Chinese automaker Li Auto Inc. specializes in alternative fuel vehicles, a NEBS company that focuses on the creation, release, and sale of high-tech electric vehicles. As investor interest in Chinese IT has waned, the company's stock price has dropped by more than 30% this year, to $22.12 per share. In spite of the looming regulatory issues, the number of firms has decreased as a result of Beijing's crackdown. The automotive industry has experienced rapid growth in recent years, and this trend is expected to continue, with revenues increasing by 93.2%. $52.1,000,786 CNY greater than in 2022, a decrease of 69.2% to CNY. Assuming a continuing loss of CNY 88.2 billion in 2023, the company will still be losing money at that point. The company is expected to turn a profit in 2023 of CNY $6.91 million, according to market analysts. 1.52 billion. It's possible that Chinese EV. If Giant maintains its projection, the growth stock could experience a parabolic rise in 2023, greatly improving the company's prospects. In addition, by the end of 2021, we will have accumulated a net cash position of CNY 10.6 billion. Li Auto, despite this, has sufficient cash on hand to deal with its growth lag. Furthermore, even if the stock price dropped by more than 30% over the course of the year, the forward EV/EBITDA for the stock is 282 times its intrinsic value, making it an expensive investment. Analysts are optimistic about Li's future despite its EPB ratio of 3.74x in 2022. Shares of stock with a $42.24 price objective, a 96.37% premium over the current market price. Inc. Zscaler. Stock in Zscaler, which provides a zero-trust cloud security platform, has fallen by 29.94% so far this year, to $209.02 per share, making a purchase in the hopes of profiting from the company's rapid expansion more affordable. A study conducted by the cloud specialist and released earlier this month revealed a 400% increase in phishing attacks against the retail and wholesale sectors over the previous 12 months. These advancements in cloud security for Zs should help the company maintain its rapid top-line growth. Zscaler, with net sales increasing 56.1% to $673 million in 2021. An exponential rise. The growth forecast for revenue is 56.3% this year to $1.5 billion. And 36.0% in 2023 to $1.4 billion. The projected net loss for this year is $372 million, up from $262 million in 2017. Despite this, Zs anticipates a 28.7% rise in EBITDA to $139 million in 2018. The growth stock is rated moderate by Wall Street analysts, with a median target price of $311.22 per share, representing a 45.41% upside. The company has a net cash position of $589 million in 2021, which is expected to grow by 20.5% to $710 million in 2022. The cloud security stock is expected to have a significant EV/EBITDA, but it comes at a high price. Bill.com Holdings, Inc., of 202x and a 2022 EPB of 49.8x. New York State, Bill.com. With his cloud-based software, which automates financial processes for small and medium-sized businesses, Bill has become a major player in this market. Since the beginning of the year, SMB's Bill stock has dropped by over 20%, to a price of $182.70 per share. Despite the fact that poor profitability has created a challenging market for tech and growth stocks. Competition in the market has led to a rise in 2021 bills, which have been accepted as legal tender. Last year's $987 million loss is expected to shrink to $308 million this year. The software firm, on the other hand, is growing at a rapid clip, with projected revenue increases of 149.6% in 2022 to $594 million and 35.7% in 2023 to $806 million. Bill.com has a pristine balance sheet after revenue increases of 50.6% in 2021. Brought it to $238 million. It is anticipated that the company's net cash position will exceed $1.3 billion this year, providing a substantial buffer against which to expand its operations in the coming years. There has been a recent flurry of insider stock sales indicating that Bill is overvalued. Not unexpected given the high forward EV revenue multiple of 28.4x. And a 4.65x EPB in 2022. A safety net of clouds. New York State Corporation, Cloudflare. Net is an international provider of cloud-based services, including software and security, to customers all over the world. When compared to the decline in tech stocks over the next 2 years, as a service Net's 28.19% drop this year to $90.59 is more severe. Bright lightning in the clouds. Consistent revenue expansion is anticipated. In 2019, we anticipate net sales of $932 million, up 42.1% from 2018, and in 2023, we anticipate net sales of $1.23 billion, up 32.7% from 2022 dollars. The profitability of cloud service providers is expected to rise as a result. Net anticipates a $289 million annual loss reduction in 2019, down from $260 million in 2021. Regardless, Cloudflare anticipates a nearly quadrupling of EBITDA this year, to $103 million, with an operating margin of plus 1.35%. The company had $663 million in the bank as of the end of 2021 and an EV of $2,022. Plus 31.1 times as much money in revenue. APB of 40.2 is also present. Besides, the multiplicities of cloud-borne flares have remained quite high. Although analysts anticipate net stock to remain loss-making for the next 2 years, they are very bullish on the rapidly rising stock, setting an average 12-month target price of $153.44 per share, an upside of 69.38%. RNG RingCentral, Inc. For businesses all over the world, RingCentral is the go-to provider of cloud-based telephony, video conferencing, teamwork tools, and customer service support. RNG shares have risen in price. Has lost 56.44% of its value since January to $83.82 per share, ranking last among growth stocks. Despite this, the software company has demonstrated excellent execution by exceeding profit per share and revenue projections in each of the last 4 quarters. After increasing by 34.7% to $1.59 billion, RNG is experiencing meteoric growth. In 2021, it is anticipated that sales will increase by 26.1% in 2022, reaching $2.001.0 billion. And by 24.4% in 2023, reaching $2.500.0 billion. Even so, the company's bottom line is expected to worsen in 2022, with a net loss of $437 million compared to a loss of $376 million in 2021. Even more so, NG is the most leveraged of the growth stocks we've included in our list. RingCentral had a net debt of $1.13 billion in 2021, which is 5.14 times annual revenue. According to the leverage ratio, experts anticipate a 10.9% decline in debt for the company this year, bringing the total amount of debt to $1 billion. What's more, when considering the forward EV, shares of RMG stock are more expensive than average. Cutting and pasting EBITDA, it's 36.5 to 1. Additionally, a PB ratio of 13.1 to 1. To the contrary, Wall Street experts are optimistic about coin-based global Inc. Coinbase. With an average price target of $211.59 per share, an increase of $100 or 52.43%. From today's closing price. Over and above the consolidation of cryptocurrency assets and growth stocks, CoinStock has dropped by over 50% year-to-date, to $122.69 a share. Revenues for Bitcoin exchanges are anticipated to decline 7.7% to $7.23 billion in 2022 and 19.2% to $8.63 billion in 2023, while coin stocks are anticipated to report a net loss of $271 million in 2022, following a prosperous year in 2021 in which they earned a net profit of $3.62 billion, down 46.2%. Given this, it's easy to see why its market value has plummeted recently. CoinStock is a good buy despite this because positive net income is forecast for 2023. With a net cash position of $3.3 billion in 2021, Coinbase is well capitalized, and its value is projected to soar by 47.4% this year, to $4.88 billion. Cryptocurrency experts are rated as a moderate buy by analysts, with a consensus price target of $275.70 per share, corresponding to a 125.02% increase over the next year. In sum, growth investors are looking for companies or markets with expansion potential. There is no foolproof method for calculating this potential, rather, it requires some subjective and objective judgment on the part of each observer. Growth investors may use certain methods or criteria as a framework for their research. But they must do so taking into account the company's current standing in relation to its history in the industry and its financial performance. To all the viewers out there, I sincerely appreciate your time and interest. Leave a like and subscribe if you enjoyed this video. Until then, we hope you find it useful. Take care.